Welcome to the Swing Trading Strategies video series. In this video, we will learn about gap trading strategy. I will also show you how to combine gaps with RSI indicator to increase the odds of this particular trading strategy. This entire series is focused on what to trade, when to trade, and how to trade. And I've covered swing trading in great depth. And if you have landed on this video directly, do watch the remaining 9 parts of the Swing Trading Strategies video series. Link to the same is given in the description box below. So by the time you finish with this video, you will have learned about how to use RSI indicator for gap trading and how to apply this trading strategy to identify high probability trades. I will take you through some basics of gap trading strategy and then will give out specific rules for using gap trading with RSI indicator. I will also point out how to identify strong and weak gap trading setups and how RSI indicator will help you in identifying gap setups which you have to target. In the end, I will show you how to trade this setup by defining risk entry, stop loss, and I will give a holistic framework so that you can apply this gap trading strategy on any given time frame. So let's get started. So the first thing that we should start with is by understanding basics of gap trading. Now gaps actually occur quite frequently on charts. Trading gaps gets difficult as price usually retraces back to close the gap window that is printed on the chart. Now before getting into this in detail, let us first cover some basics about trading gaps. Now gaps occur on a chart when there is no trading activity printed between the low of previous candle and high of current candle, or when there is no trading activity printed on the chart between the high of previous candle and low of current candle. Now I know this particular part is slightly confusing. In the next slide, with the help of a chart, I will explain this further. There are typically 4 types of gaps that are known. Number 1 is the common gap. Number 2 is runaway or breakout gaps. Number 3 is continuation gaps, and number 4 is exhaustion gaps. Now common gaps are the ones which should be avoided as they typically occur in a range. Runaway or breakout gaps happen at the beginning of a trend and they should be targeted. Continuation gaps again happen while continuation of trend, and even this particular gap setup should be targeted. Exhaustion gaps happen at the end of the trend and one should avoid trading these. It's important knowing which gap to trade, as not all gaps result in profitable trade. For swing trading at least, you should be focusing only on 2 types of gaps. Number 1 is runaway gap and number 2 is continuation gap. In the chart in front of you, there are 4 gaps that you can see. First and second gap is a case of gap down. In this, there is no trading activity between the low of previous candle and high of current candle. Third and fourth gap is a case of gap up. In this particular case, there is no trading activity between the high of previous candle and low of current candle. Now, whenever you spot gaps on charts, think momentum. Gaps mean that price is off balance, and in such cases, price does tend to move either in the direction of trend, or a mean reversion would happen where price would revert back and fill up this gap. But in either of the cases, you will see that once you see gap printed on the chart, price will move for sure. Now, gap trading is a vast subject. I will cover this in great depth in months to come. All types of gaps that we have discussed, that is runaway gap, continuation gap, common gap, or exhaustion gap, need a separate detailed video. Today's focus is on combining gap trading with RSI indicator to identify high probability trades. And to do this, we will be focusing on identifying runaway and continuation gaps only. For this particular video, we will not be covering common gaps and exhaustion gaps. Now, this gap strategy would consist of 3 main components. Number 1 is price pattern. Number 2 is gap pattern, and number 3 is RSI indicator. So the first thing that we will begin with is by identifying strong and weak gaps. So the first step for you to identify strong gaps is to check whether the candle of the gap is strong enough or not. Now there are some guidelines that I can give you that you need to follow. Number one guideline would be that candle should be a wide range candle. So this is a hourly chart, and we will be using a 60-minute or 30-minute chart to trade this setup. So look at this particular candle. This is a wide range candle. Range, that is distance between high and low, is wide enough. Basically it should be greater than 0.8 to 1%. Okay. The second guideline is that closing in case of this up candle should be near the high point of the day. Now closing for a down candle should be towards the low point of the day. That is how you judge the strength of the candle. The third main guideline is that whenever you spot gaps, if volume increases with gap, this can be one more way to identify strength of the gap. Though this is optional, but if you do spot a gap and you see strong volume pickup, that is one more confirmation that you can look out for. Now with these guidelines in mind, which of the three gaps that you see in front of you are strong enough and why? Now let's see this on the chart in front of you. Now look at this candle. Gap up has happened. Candle is a wide range candle and closing is happening near the high point of the day. Now look at this particular candle. Now this candle is not as wide as this previous candle, so certainly the wide range criteria does not meet. Even closing is not as close to the high point of the day. If you look at this third candle, it fulfills the criteria of range, that is, it is a wide range candle and even closing is happening near the high point of the day. So in this particular chart, candle 1 and candle 3 are strong candles. They fulfill the criteria of range and they fulfill the criteria of strong closing, which is why this gap and this gap is stronger than the second gap that you see on the chart. I hope this particular point is clear. Now look at the chart in front of you. One gap is marked with the arrow and another one in a box. Now which one of these two gaps is the strongest and why? Now let us begin with first gap. Clearly the candle of this gap is a wide range in nature and closing is happening near the day's lows. Also, this is a runaway gap or a breakout gap since price is coming out of a well-defined range. And whenever price comes out of a well-defined range, it suggests initiation of a new trend. Now, second candle that you see on chart is again a gap down candle. This is a continuation gap because it is forming after a trend has formed. Now, range of this candle is wide, but if you look at the closing is not strong at all because it is nowhere near the low point of the day. Now this candle is called an indecisive candle. Now just remember one thing, that when candle is indecisive in nature, odd of gap closing out is much higher, which means that a gap is created here. Whenever you see a weak candle after a gap formation, odds are high that this particular gap will close out. Now for gap trading, keep two things in mind. Number one, where is the gap forming? And number two, how does it form? Now these two questions should be your starting point of your analysis. Now where the gap forms, that actually shows whether it is a runaway or breakout gap or it is a continuation gap, and how it forms, that is with respect to strength, it actually points out whether the odds are high for price following through in the direction of trend or price will revert back and close out the gap. I hope this particular point is also clear. In this chart, you see a set of three weak gaps, right? So first gap is here, second is here, and third one is here. Now first gap is still a wide range candle and the close is happening near the low point of the day. So it can qualify as a valid gap setup. However, the last two gaps that you see, both are indecisive candles. This does satisfy the criteria of wide range, but it is not strong at all. And in both these cases, you see that gap eventually fills out or closes out. So the thing that you're looking for is a strong gap candle, and range of that candle should be wide enough for the gap to be considered as a strong gap. I hope this point is clear as well. So these are the rules that summarize strong gap patterns. Number one, candle should be wide range candle. Volume should be higher than usual. Closing should be strong when it comes to gap candles. For up candle, closing should be near the high point of the day. For down candle, closing should be near the low point of the day. And the gap window that is created, it should not be too wide. That is up to 1 to 1.5% is fine. What I mean by this is this gap window that is created here, or in this particular case, that is when no trading activity happens, this should not be greater than 1.5% because then odds of gap closing out becomes higher. So now that we have seen gap patterns and how to identify a strong gap, we will now move towards price pattern in which gap trade needs to be identified. Now this is a typical range pattern that I've shared many times before, which plays out across all time frames. For gap trading, prefer 30-minute to 60-minute time frame only. In this range pattern, price actually fluctuates within a range and then breakout happens either on the upside or downside for a trend to emerge. Now any gap that occurs within this range should be ignored, and only those gaps should be focused upon which clearly shows price moving out of this well-defined range. Now gap within a range is often referred to as common gap, and this should be ignored because this usually leads to more whipsaws in a trading account. Range at times won't be as clear as I've shown on this chart, but broadly you should be able to identify price within a range. Now range can be horizontal like I've shown in the chart in front of you, or it can be in a channel or in any triangle type of formation. I'll just explain this with charts. Now if you see, this is a horizontal range, this is a triangular range, and this is a downward sloping channel range. Let us now go through some examples of range and gap combination. Now this will help you understand the combinations that you need to target for this particular setup. In the first case, what you see is that price has formed a nice range and then you see price moving out of a range in form of a gap. Now candle in this particular case is not a wide range one, but closing is happening near the high point of the day. Now had I seen this particular setup in real time, I won't have traded this aggressively because the candle is not a wide range candle, and when a small candle forms, even though the closing is good, price typically fluctuates in a range and then starts to move higher. So had I spotted this in real time, I wouldn't have traded this aggressively. I would have just initiated some small positions to see what happens. If you look at this second gap that is marked on this chart, this is actually a continuation gap because gap is forming in the direction of trend. And if you look at the breakout candle, it is a wide range candle and closing is happening near the high point of the day. So this I would classify as a strong gap pattern which should be traded at all times. In this chart, price is in a range. This pattern is ascending triangle where top end of the range is usually flat and bottom end of range is marked by a ascending line. In this chart, price has moved out of the range with a runaway or breakout gap where candle is wide range in nature and closing is happening near the high point of the day. Such structures are high probability setups and they should be targeted for swing trading. This chart which you see in front of you is an example of price being in a range within a triangle. Now price moves out of this range with a gap which qualifies on range and strength parameters both. Now reason why trading gaps is difficult is because when gap occurs, trader begins to think that gap will eventually close out and he fails to take the trade thinking that he will buy into the retracement when gap closes out. Now this is a psychological barrier and this should be worked upon. Either you become a trend trader or you become a mean reversion trader. You cannot be both at once. Now trend trader would see such a gap forming on a chart and he would see this as an opportunity to ride the trend. Whereas a mean reversion trader would see this gap as an opportunity to short the price here so that price would eventually fill out this particular gap. So you need to decide today whether you are a trend trader or a mean reversion trader, and then you need to start working on strategies that will suit your overall psychological profile. Now in this chart that you see in front of you, first price gets into a horizontal range, breakout above this happens with a weak gap, and the gap eventually fills out. Now second breakout actually happens on the downside with a weak gap candle, and then price actually fills out this particular gap. However, if you look at the chart, once the gap is filled, price again moves lower in the direction of trend. So such variations also play out, and one must be aware of these setups as well. Now whenever the candle is weak, the odds are always high that gap would eventually fill out, and then either a new range would form or price would start moving in the direction of trend. This particular gap here is also a testimony to the fact that every trade does not work. Just because a gap forms on the chart and all the criteria are fulfilled, it does not guarantee that trade would work in your favor. This is again a case of price moving out of a downward sloping channel in form of a weak gap. Now if you look at this candle, wide range is still kind of missing and close is not happening near the high point of the day. Now since gap is weak, price moves sideways first and then starts moving higher. If gap is a strong one, price usually moves straight in the direction of trend. However, do keep this in mind that if gap is a weak gap, then either trade fails with price filling the gap and moving lower, or price will first move sideways, gather some momentum before attempting to move in the direction of gap. Do remember this point when trading gaps. So now that we have covered gap setup and price pattern to target, let us now move towards the role of RSI indicator in this swing trading strategy. Now we will use the concept of RSI bullish and bearish range to identify high probability setups. Now I have discussed RSI bullish bearish range in great detail in many videos. So if you are new to this channel and you don't know about this RSI bullish bearish range, then link to that video is in the description box below. Do check that video out as well. Now in a nutshell, under RSI bullish range, RSI indicator moves between 80 and 40, whereas in RSI bearish range, RSI indicator moves between 60 and 20. For trading gaps on the upside, we will use RSI indicator to check if price is coming out of RSI bullish range, and for trading gaps on the downside, we will check if price is coming out of RSI bearish range. So in the chart in front of you, you see I have plotted RSI indicator with clear markings of 80-40 range in green lines and 60 and 20 range in red lines. You also see 3 gap trades in front of you. First gap happens with a weak candle. You can see the candle is weak, and then price moves sideways to eventually close the gap. If you look at RSI range prior to the gap breakout, you would see that RSI was clearly trapped in the 60-20 range with RSI being close to 20. This means that prior to gap breakout, price was in bearish range as per RSI indicator. Now look at the other 2 gap breakouts that have happened on the chart. Both gap breakout happened with weak candles and price moved sideways before moving in a direction of the breakout. However, if you look at both these 2 gap out trades, RSI was clearly in 80-40 range with RSI taking support in the 40 region. This means that prior to breakout, RSI was in a bullish range, and then the breakout happened in form of gap. I hope this particular point is clear, because to trade this setup successfully on the upside, there are 3 things that need to come together. Number 1, price should be coming out of the range setups that we discussed a few slides back. Number 2, breakout should happen with a strong candle. In case the gap or the candle is not strong, you should wait out, don't trade aggressively. Typically, if a gap is a weak one, price does retrace back or move sideways, and then eventually price moves in the direction of the gap. The third thing to trade this on the upside successfully is that RSI should be taking support and 40, and only then you should be targeting this pattern or this trading setup. I hope this particular point is clear. I'll just repeat it once more. The first criteria that you need to see is that price should be coming out of the range. Second criteria that you should see is that breakout should be with a strong gap. If strong gap is missing, do not trade this particular setup aggressively. The third particular rule that you have to watch out for is that if you're trading gap on the upside, prior to the breakout, that is in the form of gap, RSI should be taking support at 40, and ideally it should be in the 80-40 range. Now look at this chart in front of you. There are 4 gap trades that I've marked on the chart. Now first gap trade fails as when this gap happens, look at the RSI range prior to this breakdown. It was in the 80-40 range. Now gap candle was kind of weak and eventually gap fills out. The second trade fails as prior to gap, price was actually in a 60-20 range. So when price is just in 60-20 range and RSI is closer to the 20 level, and when you see breakout happening in form of a gap, you should be ignoring this particular setup, because eventually price does fill out the gap and it tends to move lower. The third gap that you see is pretty interesting, as prior to gap, price was in RSI 60 range, that is repeatedly facing resistance. Gap happened with a weak candle, which eventually led to price filling out the gap, but then price moved in the direction of gap. Now fourth gap that you see happened on a relatively strong candle. Price did move sideways for about 3 to 4 hours, and then strong price action followed on the downside. Now prior to this fourth gap, see how price was taking resistance at 60-20 region. This was 20, then price rallied, that is RSI rallied to 60 level. It repeatedly took resistance when this range formed, and then eventually fourth gap happened and price then moved down with momentum. So I hope this overall setup is now clear to you. So this chart that you see in front of you is a reminder to spot and target gaps at the right moment. Now remember, you are targeting runaway or breakout gaps and continuation gaps as such. Now once price has risen about 10 to 15%, let's say on an index, and 20 to 25% on a stock, targeting gaps actually becomes very risky, as it gets very difficult to distinguish between a continuation gap or a exhaustion gap. Now chart that you see in front of you has all the combination working in its favor. There's a strong gap setup, candle is strong, RSI is repeatedly taking support at 40, but still you see that gap fills out and trade eventually fails. Now the thing is that in hindsight now we can see that this is an exhaustion gap, but in real time it will be very difficult to identify whether this is an exhaustion gap or merely a continuation gap. Now the thing is that is why you need to see where the gap is forming. In case you are a beginner in this particular setup, I would urge you that you should only target runaway gaps at the beginning. That is when you see price has fallen down and you see a range forming, and then you see a breakout happening in form of a runaway gap. Those are the sort of setups that you should be targeting initially. As you gain experience, move towards continuation gaps and even sort of identifying exhaustion gaps. So again, I'll repeat, if you're a beginner, start by trading only runaway or breakout gaps. That is the setup we have discussed. When you get some more experience, try and target a continuation gap. And when you get better at this, that is distinguishing between continuation gap and an exhaustion gap, then you can move towards exhaustion gap as well. The thing is that here I have a complete chart printed. That is why I can clearly see that this is exhaustion gap. Had it been in real time, I would have assumed that this is a continuation gap as well. So which is why you need to have a price percentage rule, that in case there is a prior move of 10 to 15% on index or a 20 to 25% move in stock, stop looking out for gaps until and unless you see a sustained down move. That is if you want to trade a setup on the bullish side. I hope this particular point is clear. So what I've done in this video is give gap trading a context within a framework. Now quite often traders trade gaps randomly, and this should be avoided. You need to focus on strong gaps, range price pattern and RSI range. This is the combination which you should target. Now don't risk more than 1% of account on any given trade, and stop loss for this particular setup would be the recent high or low of the range from which the breakout occurs. I'll just show this on chart. Now suppose you are trading this particular gap, that is the candle gaps down here, and you want to short sell here. So the stop loss for this particular trade would be high of this range. Now I do understand that some of you might feel that this stop is too wide, but when you are short selling, you need wide stop losses because price tends to be volatile and it can easily move in this particular range. I hope this point is clear. So now what you can do is you can try and identify trades and post it in the comment section below. Focus on the combination I have discussed above, that is strong gaps, range price pattern, and RSI range. So that's all for this week in this swing trading strategies video. In case you have any doubt about what I've shown you, just leave a comment below and I'll get back to you as soon as possible. Thanks a lot for watching this video. Take care and be safe.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.